Hello everyone. We are going to discuss today the first question of pre-March 2025 mock. So let's go with the requirement. Let's start with the requirement. Prepare a report for the directors of W company which calculates the profit and loss on the sale of infrastructure sports service division. So in the first part, we need to calculate the profit and loss on the sale of infrastructure division. Second part, calculate the percentage gain or loss to the shareholder of T company under both the scenarios of all shareholder accepting the cash offer and all shareholder accepting the share exchange offer. So there are two offers, share and cash. Conclude solely on the financial grounds whether T company shareholder will accept the cash or share exchange offer. Okay. Then the third part, discuss the problem with achieving the forecast operating synergies from the acquisition and the steps which W company board can take to achieve these synergies. And then discuss for both the share exchange and cash offer the impact on W company financial situation of the purchase of T company and the likely reaction of the W company shareholders. And the last part, discuss the ethical consideration from W company and T company viewpoints relating to the possible private offers of job and cash bonuses to T company directors by W company. Professional skill marks will be awarded for the demonstration of skills in analysis, skepticism, and commercial acumen in your answer. So that was the full question. So let's read the text as well. W company is a construction company which has focused on large public sector commercial and retail projects. W company has a reputation for well constructed buildings, although it has faced recent criticism for not making as much use of the technology within its buildings as its competitors. Although W company profits have shown a steady increase over the long term, they have sometimes fluctuated significantly year on year, depending primarily on the economic cycle. W company board therefore made a major investment in the infrastructure support services, which it felt would be less affected by the economic cycle and would therefore smooth out profits. Okay. The services offered included energy consultancy, public space design, and management. A separate infrastructure support services division was established, and its management team was mainly recruited externally. So now you are technically offering two businesses, right? Okay. Then, however, the infrastructure support division has not delivered the profit that W company board hoped it would. Some of the managers recruited to the infrastructure support division from outside have since left W company. They criticized W company board for its lack of understanding of the infrastructure support division and its failure to give the division sufficient attention and clear strategic direction. These are the serious allegations. Because in order to hire the new management, your reputation will be in question now. In order to raise capital for future investment, W company has decided to sell its infrastructure support division for 18.25 million. The sale of the division will consist of 25% of W company assets and current liabilities. The value of the W company asset is currently 68,960 and the current liability is 4860. Okay. The board of W company has also decided to make an offer to acquire the entire share capital of T company. Okay, the T company is an unlisted construction company specializing in smaller commercial and retail development. It has become successful primarily because of its use of technology. So you were lacking in technology. This company is advanced in technology, in enhancing its construction operation and also in utilizing internet connected small devices with the building it constructs. Three of the T company executive directors own 15% of the share each. No other shareholder own more than 10% of shares. A significant number of T company employees have been with the company for some time, and relation between senior management and the employees are good. W company board believes that T company offers a good opportunity to develop in the construction sector, and there are a number of opportunities for synergies, including T company technology to enhance the efficiency of its own operation and product offering. So relevant information is given. T company most recent profit is 1300 million before tax, before interest and tax. After deducting tax allowable depreciation is this. T company annual cash investment is 173 million. It is estimated that T company free cash flow will grow by 6%. Everything is given, to be honest. Cost of capital is 13%. You will raise skepticism on this. Company tax rate is 20%. It is expected that this rate will not change in the foreseeable future. You can also raise the skepticism on this. Company currently has 1200 million shares in issue. Company directors are proposing that acquisition of T company will be made through one of the following members. Cash offer of this, a share for share of this. T company will become a wholly owned subsidiary of the W company, assuming all shareholders accept the cash offer or the share exchange offer. This is for the combined value. It should be assumed that acquisition of T company and the disposal of the infrastructure support division will take place. Following information related to the combined company revenue is given, profit margin is given, operating synergy is given, tax rate is 20%. In year one, combined company will require additional capex. In year 2 to 4, it's forecast the pre-tax profit, including operating synergy, will grow by 10% and additional investment by 8%. After 4 years, it can be assumed that free cash flow will grow by 7%. Combined company cost of capital can be assumed to be the same as the W company current cost of capital. That is the cost of capital prior to the announcement of the sale. Okay, that's a big assumption. So we need to question this assumption. Highlight this, okay? It's a very big assumption. W company has 5,000 million shares in issue, trading at this with a total market value of this, book and market value of this. Pre-tax cost of debt is 8%, is equity beta is 1.26, risk free rate is this, market risk premium is this. Currently has 1,200 million shares in issue. Question is easy, it's not that difficult to be honest. W company board has been considering how to pursue T company shareholder to accept the offer. One director has commented that T company 3 directors who own 45% of the shares between them are dominant figure within the company. They can be privately offered jobs with W company and cash bonuses if they take the jobs, but dismissed once the acquisition has taken place if there is no role for them in the management structure. This is unethical. You are offering them. First, unethical is you are offering them only the 45% shareholders, you are offering free favorable terms. You're not offering terms to all the, you are not doing equal treatment. Second, after doing the agreement, once you acquire the company, you will dismiss this. So again, unethical. You will not fulfill your promise. So we have to discuss this as well. So let's do the numerical first. And then we will discuss the theory. So any question till now? Let's solve the first part. Calculate the profit and loss on the sale of service division. Now let's read the first. In order to raise capital for future, The sale of the division is consists of 25% sale of the asset and current liabilities. So you will sell the services for 18.25 million. 18.25 million. Okay. Sale proceed is 18.25 million. 18.250. All figures are in dollar million. Okay. Now the sale of the division will consist of 25% sale of the asset and liabilities. And assets and liabilities are 68,000 and 4860. Assets are 68,960 and liabilities are 4860. 4860. Okay, our share is 25%. Okay, 25% net assets. Bracket start. Firstly, calculate the net assets into 25%. So, what is the gain? That is a gain. That is a gain. Okay, put the comma as well. That is first part. Okay, you can also write this appendix number 1. Let me add one row. Control X down. Appendix 1. Now appendix 2. Okay, what is the requirement number 2? Calculate the percentage gain or loss to the shareholder. Under both scenarios. Okay. Now we have to do much working. Combine value as well as the individual values. First of all, market value of W company. WALDITH. Okay. So we will calculate the value of this company. Then market value of tin slit company. Okay. Then we will calculate the combined value. So now let's do one by one. So market value of W company. Let's go to the into the detail. It would be given somewhere. I think all the information here is about the T company. So W company must be here. Yes, W company shares are 5,000 and trading at 20.41. 5,000 and 20.41. Okay. So you can also write all figures are in dollar. Now let's calculate the market value of T company, which is a major part. Okay. How to do this? We have to find through free cash flow methodology. Okay. How many years structure we have to make? Recent profit is given 1300. Capex is given. Free cash flow is given. Is there any year structure is given? Most recent profit is given. Capex is given. Depreciation is given. Free cash flow will grow by 6% for the foreseeable future. Cost of capital is given. I think nothing is mentioned. So we will assume that cash flows will grow from today till perpetuity. Single growth model. So let me calculate the free cash flows. Profit before tax. 1300. Okay. Add back the depreciation. 419. Okay. After deducting tax allowable depreciation. Okay. Capex is 173. Okay. What is missing? Is there anything missing? Tax is missing. What is the tax rate, guys? 20%. So let me deduct the tax here. Okay. So now let's calculate the free cash flow to firm. Profit PBIT minus tax plus depreciation minus capex 1286. Okay. So growth is given 6%. 6% is very high growth, by the way. 6% is very high growth. Remember, I'm giving you a practical advice. Growth cannot be that much high. Why not 6% for the foreseeable future? Growth cannot be more than the long-term growth of your country. Growth cannot be more than the long-term growth of the overall GDP. If the overall country is not growing, but you are assuming that your company will grow, yes, your company will grow for a few years, but not for the foreseeable future. Okay, you have to challenge this growth as well. Cost of, or this challenge will be called commercial acumen. You will write that this growth seems to be too high because over the longer period of time, in the perpetual time period, growth cannot be more than the overall growth of the economy. So what is the cost of capital, guys? 13%. So market value of firm. Free cash flows into 1 plus G divided by 13% minus G. So 19474. Okay, we have to deduct the tax. What is the tax, guys, of this company? Anyone, what is the debt of this company? What is the debt of this company? No tax debt. Is anything written here? Okay, other exhibit. Nothing is written. Other exhibit. Here. Where it is written? Company has, this is not a T company loan. This is a W company loan. No? There is nothing is mentioned about the T company loan. It's not mentioned, guys. It's a debt free. Nothing is mentioned about the combined loan or the loan of T company. That should be mentioned here. There is no loan. Even nothing is mentioned about the interest. Market value of equity is same. So if you want to calculate market value per share, number of shares are given. What are the number of shares? 1200. Now let's do the combined company. Combined company value. So let's start from the combined revenue. In first year, this is 46,000, 18%. Okay, how many structure? We have to make 4 years. 4 years. One, two, three, four. Combined revenue. 46,600. Profit margin. Operating profit. 18% of this. Okay. Then operating synergies. 750. 750. The profit before interest and taxes. Okay. Next, it is written that tax is 20%. Okay. In each of the, in year one, the combined company will require additional investment of 426 million. Capex, 426 million. In each of the 2 to year 4, it is forecast that pre-tax profit, including operating synergies, will grow by 10% per year. So this will grow by 10% per year. %8 growth. 10% growth into 1.1. Into 1.08. Okay. Every year. Okay, what about the non-cash charges which we have to add? Nothing is mentioned. So we'll assume that depreciation is equivalent to the normal capex. The operating synergies will add. You will add the operating synergies. So free cash flow to firm. Okay, please check till now. Any question? Mhm. Normal capex is not working capital. Capex. Capex is non-current assets. Addition in non-current assets. But nothing is mentioned. So you have to take the assumption. You will write this assumption that in this formula we normally add back the non-cash charges, but no information is given. That means it is assumed that non-cash charges is equal to the uh, 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 non-cash charges is equal to the normal capex, the replacement capex. I have added the synergies here. This is synergy. This is called synergies. So 750 plus 8388 total 9138. Okay. So let's calculate the cost of capital now. So let's go to the working. Cost of equity. Risk-free rate is 4% plus beta is 1.26. Market risk premium is 7.4%. 13.3%. KD. KD is 8% into 0.8. So market value of we will use the market value of the W company. Equity and debt. So what is the equity value? 5,000 million into 20.41. Okay, what is the debt value? 23,780. Okay, this is equity. This is debt. Let's calculate the WACC. 12% approximately. This is also an assumption that you are assuming that W company cost of capital will remain same. So we are taking a lot of assumptions here. Present value of year 1 to 4. NPV bracket start 12%. Select all cash flows. Okay. Then present value from year 4 onwards. last free cash flow into what is the growth after year 4? 7%. Is also too much. Divide by cost of capital minus G into discount factor of last year 1.12 raised to power minus 4. You will take the last cash flow into 1 plus G divided by cost of capital minus G into last year discount factor minus last year discount factor. Okay. So what is the total now? Market value of business. So market value of equity is deduct the debt. And there is one debt. 23,780, right? So this is the equity value. Okay. So now we have everything. Now we have everything. Market value of WT is this. Market value of T company is this. Market value of combined company is this. So synergy is this. Combined company minus the individual values. Okay. This is synergy. So now you can calculate the cash offer and share for share. It's up to you. You want to make a table or directly you can do this in a simple way. So if I have to make a table, cash offer, pre acquisition okay, what is the name of the companies? W company. Here's market value per share, total market value. Post acquisition value. Okay, number of shares are 5,000 and 2,000. Okay, let me write the directly total value. There is no need of solving this, no? Okay, so combined value is this. Shares of acquirer will remain same in every situation. But we are offering cash to the other company. How much cash? 17.30 for each share. 17.30. So what is the remaining value? Oh, it's a loss. Divided by the previous value. something wrong or is this the gain? I think something is wrong. Cash out of 17.30 for each share in T company. Oh, it's 1200 million. It's not 2000. 1200 million. Now it is correct. Now it is correct. Okay, now it is correct. Okay, now let me copy this for the share for share. The good thing is now we can do it quickly, okay? Share off. Okay, this is exactly same, but we have to correct the market values. Okay, combined company value, let me copy it from above. Only from. Okay, how many shares we are offering? A share for share of 5 shares in W company for 6 shares in T company. So we are offering 1200 divided by 6 into 5. We are offering 5 shares. Okay. So total shares are now 6,000. Market value per share 21. This is again 2.26 and 7.18. So that is, we are done with this part as well. Now we have to write the report on all this. Report. Okay. Report to the board of directors, WALDITH. Okay. So starting from the introduction. You have to write in the present tense everything. Now everything. This report estimates the gain on the sale of infrastructure division. It also estimates the gain of the shareholders of T company and W company. Although it is not required, but still you can write company shareholders on the acquisition of company by W company. Okay. it covers that shareholders of the company prefers which method of acquisition on financial basis. Yes. Okay. What else? What else in the report? Ethical issues. And no, ethical issues is B part. Impact on the W company financial situation and the likely reaction. And it also estimates impact on wealth of shareholders and likely reactions of shareholders on this merger. Okay, I think it is good enough. Now we will do one by one. Now keep the in front of you. I think there is nothing much about the first part. We have to discuss about the third and fourth part. The problem with achieving the forecast operating synergies from the acquisition and steps which company board can take to achieve the synergies. So can you highlight which problem we can face from achieving the synergies? We didn't write this as well. This report also discusses the problems in achieving operating synergies and how to overcome that. Anyone? What problems we can face in achieving the synergies? Integration problem. Let me write and let's add your points one by one. There can be many issues which acquirer may encounters while acquiring uh, target company. However, in this scenario, information is, to be honest, information is not given. Information is not not given to assess the scenario related problems. Okay. So now you can write lack of sufficient information may raise a question about the estimation of operating synergies. Nothing is mentioned. It's only mentioned that you will get a synergy of 750 billion. How come? How you will achieve that? That is not mentioned. So you can raise a question that because of this, maybe this is overestimated. These synergies may be over estimated by the limited available information. Okay, you can raise this question. There can be other specific information, specific problems of not achieving synergies. For example, now I will take all of your points, okay? For example, what was the first point? The student has written over optimistic. I have written the over optimistic as estimation. For example, if in acquiring the key company, if sufficient time is not spent on proper due diligence and acquisition of information, it can lead to failure of merger in future. Okay. If W company does not spend does not hire experts, due diligence experts to evaluate the current situation of company, it can lead to problems in future. Okay. Company should considers the cultural difference between two companies. This culture is very much important. You know, when I was doing a job in my previous company, a year before, last year, uh, in that company, there were 6 working days. Even Saturday was on. And they were strict. Timing was 9 hours, 9 to 6. And although there were annual vacation, but they often didn't allow they often don't allow this to their employees. But this is exactly entirely different in my new company. 5 working days and flexible timing. If you're unable to catch the office, you can do the work from home and you can take the holidays at any time. You can take the vacation anytime. So this cultural difference is it's like if someone asks me now that I will give you a double pay and move to the previous company, I will never, because I have been adopted, I have been trained, although it's few months now, but still I have been trained. My mind, my mindset has been trained according to the new company. I can't go to the previous company because previous I will feel kind of a slavery in the previous company. Are you getting this point? Cultural difference. Although you often write this very casually cultural difference, but cultural difference is a way more important point. Company should consider the cultural difference between two companies and the management style of both companies. If this is not considered well, employees of target company can leave the group after acquisition, which is not a good thing, which will lead to acquirer to learn new things quickly. Okay, वो छोड़ जाएंगे. You have to learn the things quickly, which is not possible, which is not good thing. Okay, and there is another problem. Yes, in W company, according to scenario, there is there are some issues with handling the management. If after acquisition that continues and new employee do not feel respected, they can leave the firm. Remember, it was mentioned the scenario here. Lack of understanding and communication. You can also write that. Currently, company has a problem of lack of communication among divisions. It can also to lead to future problems in group. Okay. So you have to identify the problem, then you have to identify the solution. Now give the heading. There are the steps which company board take to achieve the synergies. What are the steps? You need to correct this. You need to correct all the problems. Okay. Now you have to write that how you will correct this. I'm writing few points. You can add later the other points. The first step for company is to proper is to assign a expert due diligence team and properly evaluate all the information related to estimation of operating synergies. Okay, especially technology part. So the first step, you have to gather the information accurate. Okay. Now, next part. Company should list down all potential issues that can come during or after acquisition, and should draft a proper or detailed integration plan to acquire the okay. Yes, integration plan should be executed timely with the help of senior team. Okay. Right? Company should assign senior roles from management of both companies, develop develop culture of mutual respect, something like that, because uh, understanding. So it will cover our both point, right? Any other point? Any other point? हाँ जी. WT company should spend enough time on the operating structure of uh, company so that it it integrates efficiently into operations of W company and W company and realize realize the synergy benefits. You can also write other points as well. The company should develop a culture of autonomy. Company should give the enough autonomy to the employees of T company so that they can work well, they can effectively work well to generate synergies. Okay. And then what else? Then you can write the likely reaction of the impact and likely reaction. Impact and likely reaction. Okay. You will refer this information to the appendix. Okay, what is appendix? By the way, it is very obvious based on the financial terms. T company gain is more in the share for share. Although you will write here because it is examiners asked that conclude solely on the financial ground whether T company shareholder will accept the cash or share offer. You can write this as well here. On financial grounds, T company will select share or share offer. Okay, but here impact on the wealth W company financial situation of the purchase of T company. Now you will have to write according to the W company perspective. In cash offer, W company gain is only 2.37%. And share offer, W company gain is 2.26%. Although in both cases it is almost same. But you will write one paragraph on the cash offer, one paragraph on the share offer, and one paragraph generally on the assumption. Okay, what you will write on the share for share? You will write that in share for share, W company gain is 2.26% according to the appendix number 3. Okay. But in share for share, and it is likely that T company will also select the share for share because their gain is higher in share for share. The benefit of share for the W company is they do not have to raise the cash. They do not have to pay anything. But the problem is that their control will be diluted. How much? 5,000 over 6,000. So their control will be diluted. So previously they were a shareholder of 100%. Now their share will reduce to 83%. Then you will write in cash offer. In cash offer, their gain is slightly higher. But the problem with the cash offer is the company needs to arrange the cash for the shareholders of T company. They have to go to the market to arrange the cash. They have to borrow from the market. In future, they have to pay the interest on that. The benefit is they will own the 100% of the company. But the problem is they have to borrow from the market. Okay. So in share for share, your control will be diluted. 17% shareholder will be external. Somebody else will be controlling. Somebody else will have a significant influence in the company. And on the cash offer, uh, you have to arrange this cash 20,760 million. And you have already loan of 23,000 something, 23,780. So your gearing will become almost double from the current level. Okay. Although there is a money inflow from the infrastructure division. So what will happen? Either you have to borrow funds from the market or you will use all the funds available from the sale of the infrastructure division. What is the fund? 18,250. So almost all. So you have to borrow nominal amount from the market, but 18,250 you will use from the sale of infrastructure division. Okay. So this is a general discussion. Impact on the wealth, 2 paragraphs, then the likely reaction of the shareholders. ये तो कर सकते हैं. You can write this, right? What is the likely reaction of W company shareholder? Can anyone tell? W company shareholder can express their feeling like W company shareholder reaction can be different for cash offer and share offer. In cash offer, they have a gain of 2.37%, although it is marginally higher than the share offer. But the problem is they will be short of cash. They will be out of cash. Either they have to borrow from the market or either they have to consume all the cash which is available from the sale of the uh, infrastructure division. You can write this, okay? And then from the share for share, although the gain is slightly lower than the cash offer gain, but the benefit here is company does not have to borrow from the market and company does not have to spend cash which is available from the sale of the division. So company can invest elsewhere that cash. But the problem is 17%, approximately 17% share will be held by someone else. So your control will be diluted, your EPS will be diluted. Then you will write the conclusion. Okay, we can also use the EPS to support our answer, but we can't discuss the EPS here because That is not mentioned in the scenario. The profits of both companies are not mentioned in the scenario. Acha ji, what about the conclusion? What conclusion you will give? What conclusion you will give? We can give a conclusion that according to the information given in scenario, there are chances that on financial basis, tin company will choose share for share offer. However, it depends upon the actual realization of the earnings. It depends upon the actual realization of the values in future. So, shareholder of tin company will not accept anything on the face of it or anything purely on the financial basis. They will also question on the accuracy of the figures. ऐसा नहीं है कि you will write somewhere that okay, the gain of one thing is 8%, the gain of other thing is 7%, so I will go for 8%. Maybe the gain is 8%, but you may not realize this. You may not achieve this. So you will write a conclusion, although according to the scenario that on the financial grounds, T company will go for share exchange. However, the share for share gain is depending upon the actual realization of the estimated figures. The T company shareholder will question on those figures. If the assumptions are reasonable, they will go for the assumption, otherwise not. Yeah, they will do the sensitivity analysis and okay. Although it is not mentioned in the question, but let me guide you. We also have to write assumption. We have maybe in the actual exam, you also have to write about the assumptions. Or yahan in this case, in this question, there were certain assumptions which are very, very important to discuss. If anyone, let's make a list. Number one, there is no cost of capital information given for the tin company, whether it is correctly estimated, whether it is properly reflecting the risk of the tin company. Number one assumption, right? The growth of tin company for the foreseeable future is 6%, and the growth of combined company for the foreseeable future is 7%. That seems to be very high. It should be noted that practically the growth of any company cannot be more than the growth of the overall economy in the long term. So how do you know the growth of that economy is 6% or less than 6%? It's a common sense. The growth of any economy, the growth of developed economy is 1 to 2%. The growth of India, China, the emerging countries is 7%, 8%, 9%. But that is for current. Once you develop, your growth will go down. You have to challenge that, okay? And third, you can also write that. It is assumed in the scenario that depreciation is equivalent to the replacement expenses. Okay, please write it somewhere. I'm writing this assumption. You can use it anywhere else as well. It is assumed. Yeah, this is a general assumption you can write anywhere. It is assumed in scenario that non-cash charges or depreciation is equivalent to replacement capex, which may not be true as depreciation is based on historical cost and replacement capex is based on current values. So both can't be equal. You will do the replacement capex now, right? The replacement capex is based on current values. And depreciation किस पे है? Depreciation is based on historical values. So both cannot be same. Okay, you can write this assumption. You can write another assumption about the tax. You can write one more assumption. It is assumed in the scenario that W company cost of capital will be used to value the combined company. However, when we combine the two companies, the beta of the combined company will change, which can lead to the change in the overall cost of capital. So, practically or realistically, combined cost of capital cannot be equal to the cost of capital of the W company. You can challenge this. Look, you can write this. It is mentioned in the scenario that W company cost of capital will be used to value the combined company. However, this is not realistic or this is not practically possible because whenever we combine the two companies, beta of the two companies will change because the operations are different. One is more into technology, one is less into technology, right? So if the beta of the overall group is changing, so that means cost of capital will change. If the cost of capital is changing, so how can you use the previous WACC to value the new WACC? So you can challenge this assumption. Although examiner does not didn't ask for the assumptions here, but in final exam he will ask. Okay, okay, okay. One more assumption which you can write everywhere in merger. Practically, if acquirer acquires a target company, there will always be a merger or acquisition expense. You have to hire the lawyer, you have to do the due diligence, you have to hire the investment banker. So that is 2 to 3%, 2 to 3% of the total value. That is material cost, which we are not considering here. Okay, you can also write this. Okay, any other assumption? The rest of the assumptions are. Then you can challenge the operating synergies assumption, whether it will be achieved or not. It depends. No information is given whether how this 750 million has been calculated. No information is given that how this 18% has been calculated. You can challenge this. Okay. Index number one, I think this is correct, right? Percentage gain 6.6%, free cash flow value is correct. 7 point, this is good. 2.3, 2.7, this is good. This is the report, subject. Okay. Good, good. You can also write that under cash offer the gain of W company shareholder is this, bracket, appendix number this, appendix number this. This is great. It's good assignment, by the way. This person, whoever has written this report, this person will get 5 marks on communication. You know, there are 10 professional marks. 5 marks are for communication on the style of the report. So this student will get exactly 5 out of 5 marks. I'm not talking about analysis, skepticism, commercial acumen. Just on the format of the report, just on the layout, just on the presentation. You will get full marks on the communication.